Hello and welcome to BQ Prime. You're watching Talking Point, and my guest today is Gautam Duggad, Head of Research, Institutional Equities at Motilal Oswal. Gautam, morning, and thank you for joining us on BQ Prime. To begin with, Gautam, you came out with a report post the earnings. The header was said that impressive but loaded. Can you explain? We saw a good set of earnings coming across the board, but why do you say it's loaded?
Sajeet, good morning. Thanks for having me. I think the earnings were in line with expectations, both for Nifty as well as our broader coverage universe. The only problem that I had with the earnings was this was very lopsided earnings, as in just two sectors drove most of the earnings, which is auto and financials. In fact, the 16% growth in Nifty and 15% earnings growth in our coverage universe, it drops to just about 5-6% if I take out financials. And it's not something which is new. It's been going on for 2 years now. In fact, if you look at the full year FY23 earnings also, now that the year is behind, FY23 Nifty earnings are up 11%. But without financials, earnings are flat, absolutely no growth.
Hmm.
For our coverage universe also, the trend is similar. The only refreshing change in the last 2 quarters has been that auto has started and contributed in the last 2 quarters, where trend has changed in the last 2 quarters after a 14-15 consecutive quarter of earnings downgrade. And now it is last 2 quarters we have seen an earnings upgrade for 2 consecutive quarters. However, going forward, it would be good if there are more sectors which are contributing to the earnings growth. Because if it is led by just one sector for such a long period of time, then market tend to basically start discounting earnings in a very different manner, which is why I said it's a bit lopsided in that sense.
Mm-hmm. If you look at autos, we've seen the jump in autos coming for last two financial years, uh, primarily because the base was very low, and during COVID there was a big hit which came in, and uh, still in terms of volumes for some of the segments within the auto, they're still below the pre-COVID levels. Uh, do you see the normalization of growth for autos in FY24, and if that happens, what is the kind of impact that will have on the Nifty earnings?
So, Sajid, you made a good point that for 5 years, auto earnings had gone nowhere. Let me give you a comparison. FY18 was a very interesting year because it marked the bottom of the financial earnings and top of the auto earnings. What happened in FY18? Auto earnings peaked out at a total profit of 31,000 crores for Nifty auto companies. From FY18 to FY23, the same earnings came down from 31,000 to 25,000 crores, right? While in the similar period, the banking and financial earnings in Nifty went up from 45,000 crores to 210,000 crores. So this is how divergent the journey of two domestic cyclical sectors has been. So FY23 therefore is the first year after a long time where auto earnings have grown. We do expect this momentum to sustain because both two-wheeler, four-wheeler, and in fact, CV cycle as well is quite good right now. We expect this momentum to sustain. Demand is strong. Order books are looking very healthy. Supply situation, which has impacted large part of FY22 and some part of FY23, has eased out a lot. And at the margin, you have seen commodity prices correcting too. So all of this means that auto earnings can have a very strong year again in FY24, which is what we are building in our numbers. We are actually expecting auto earnings to almost double in the next 2 years between FY23 to 25 and keep contributing to the broader index. So, which is why we turned overweight on auto back in January when we saw first evidence of earnings upgrades happening in auto after 15-16 consecutive quarters of earnings downgrade.
Mm-hmm. Interesting. You're talking about doubling of auto earnings at a time when industry itself has been very circumspect in the growth. If you look at the two-wheeler segment, they're looking at teen growths in teen, SUV maybe 10% plus, but normal car segment below 10%. In the CV, they've been very it's very patchy in the sense that the LCV market is not growing much, but the medium and heavy commercial vehicles are growing at a faster pace. So, despite that, you see this doubling of earnings coming in.
So let me explain that a bit, Sajid. So doubling of earnings doesn't necessarily mean doubling of top line. Top line may continue to grow at whatever pace it has been growing in FY 22-23, maybe some percentage point lower, right? Because now large part of the low base of FY 22 is already there in FY 23. But margins still have a long way to go. In fact, FY 23 gross EBITDA and PAT margins of auto sector were one of the lowest in last 7-8 years, right? So gross and EBITDA margins have corrected anywhere between 400, 500 to 600 basis points over the last 5-6 years. And we are expecting a very modest rebound over the next 2 years between 200 to 300 basis points. But given the inherent operating leverage which is residing in the auto P&L, this will mean that the picture when it comes to EBITDA and profit growth can look meaningfully different than the top line growth. Second, in auto sector, you always have to take Tata Motors a bit separately because it tends to distort the picture on both upside as well as downside. In fact, in this quarter's earnings itself, if you look at the numbers, we were expecting for our auto coverage universe the earnings to grow by 70%, whereas the actual growth has been 115%. Why it has happened? It's happened because Tata Motors numbers were significantly ahead of our expectations, right? Tata Motors alone contributed to a beat of 3,000 crores. Without Tata Motors, the numbers were very good, very strong, but still in line, right? So if you look at the same comparison for Nifty auto companies on an annual basis, by removing Tata Motors, the growth numbers will look bit more moderate than what the optical numbers suggest, because you've had 4 years of consecutive losses in Tata Motors between, I think, FY 19 to FY 18 to FY 22. And now we're expecting the next 2 years for Tata Motors to be very strong. So that tends to distort the picture a little bit when you compare aggregates for auto. If you look at the same numbers, X of Tata Motors, the numbers look a bit more normalized.
Just to get a clarification, when you pencil in this kind of growth, have you penciled in the kind of change that the P&L will have for all these auto companies, given electric would form a good chunk of their sales going forward? Mahindra has already warned that there may be a change in the P&L, the margin structure going forward in the next 2 to 3 years, as uh, they go and ramp up to electric and get 1/4 of the sales in electric. So, have you penciled in that kind of changes that could have come in or will come in?
Yes, Sajid, but at the same time, let me qualify it. The EV has been around for a long time now, at least in discussion, right? In terms of actual numbers on the ground, the picture is very different. It is still a very minimal or very minuscule portion of the overall P&L, depending on which company you look at. So while it's part of a dominant narrative when you discuss the auto sector and its trends and the medium to long term investment thesis, but from the short term point of view, from a next 1 to 2 years, it is not as if the EV is going to change the complexion of the P&L and balance sheet. Large part of your numbers will still accrue from ICE vehicles, whether you talk about two-wheeler or three-wheeler or four-wheelers or C.
Okay. Coming to banking and financials, last quarter, NIMS peaking. Do you see NIMS to be in the same range, or you're going to see some kind of moderation coming into NIMS for financial banking and financials?
So our expectations on NIMs, Sanjay, is that there should be some moderation there because you've seen a repricing of liability happening instantly, as is always the case in a cycle. But deposit repricing usually happens with a lag. So as you move forward in FY 24, in subsequent quarters, you will see NIMs moderating by 20-30 basis points, depending on which bank you talk about. But even then, those NIMs will be very strong and healthy because FY 23 and large part of FY 22 also had seen a substantial expansion in net interest margins. So even if they were to correct by 20, 30, 40 basis points, at an absolute level, they will still look very chunky and healthy. So that is why we are saying that despite the high base of financials, as I just pointed out, that financial earnings are up 5x in 5 years. On that base also, for the next 2 years, we're expecting the earnings to compound at about 17-18%. In fact, just to give you a statistical trivia, FY23, the total profits of 11 financial companies in Nifty have already crossed 2 lakh crores. So they are at about 2.1 lakh crores. We are expecting them to hit a 3 lakh crore mark as a profit pool for financials in FY25. I mean, if you look at FY20, the entire Nifty profit used to be 3.5 lakh crore. In 5 years' time, you will have just financials alone contributing 3 lakh crore of profit pool.
So within financials, how do you distinguish between how PSUs and the private sector will be performing? Are you still going to be bullish on PSU outperformance?
Yes, absolutely. We've had a substantial overweight call on PSU banks for last year and a half running. We have both SBI and Bank of Baroda in our model portfolio, and we are keeping the weights intact. In fact, the numbers have been very strong. The commentary is extremely strong too. And we've not seen PSU banks delivering 0.6, 0.7% net NPA and 16 to 18% ROE for a long, long time and still trading below 1.5 times. So we think that there is some more juice still left in that trade, given that you're still talking about a 13-14% credit growth at the system level, broadly flattish to 20-30 basis point of a decline in NIM, and asset quality still has a role to play in the PSU balance sheet. If you recall, the private banks provisioning costs started correcting or contracting at least year and a half before the PSU banks. So private banks now no longer have the advantage of a low base as far as provisioning cost is concerned. But for PSU banks, you still have that advantage running in for at least next 3-4 quarters as far as the provisioning cost is concerned. So we expect the PSU banks profitability to remain very strong over the next year and a half, and asset quality also to play a good role because if you look at the internal details of the asset quality performance of various PSU banks, you don't see any signs of stress right now. So we have an overweight call on financials, within which a big overweight is on PSU banks, marginal overweight on private banks, and slight underweight on NBFC. The interesting trade this year in the financials could be some weight reallocation from banks towards NBFC, given that we are now comfortably behind the peak of the interest rate cycle. And this week's monetary policy will therefore play a very crucial role in building that narrative. In fact, already you've seen a substantial AUM disbursement growth in most of the NBFCs in Q4 FY23. Your interest rates, peak of the interest rate cycle is behind. Generally, this is the backdrop which works very well for NBFCs.
So you will be betting on what, Bajaj Finance and
Yes,
others?
we have three preferences there. We like Bajaj Finance, which is part of our model portfolio. But aside of Bajaj Finance, we also like Mahindra Financial and Chola. So these are the three preferred names as far as NBFC is concerned.
So you're also betting on rural finance to pick up going forward.
So it's more a company specific, a bottoms up call rather than taking a very 30,000 square feet view on rural finance as such.
Mm-hmm. Looking at the laggards, metals were the laggards. Profitability was fell by nearly 40-45% in Q4. How do you see the metal pack performing? Do you see further correction in metal prices going forward, and hence the impact on the profitability?
So metals is a global sector. A lot of things depend on how the global macro pans out as far as growth, interest rate, and inflation trends are concerned. FY23, we've already seen commodity prices correcting after the initial flare up during the Russia-Ukraine crisis. So if you look at the metals profitability, FY22 it shot up significantly. In fact, if I were to just exaggerate a picture a little bit, the total profit of metals in Nifty was 7,000 crores at its bottom in FY20. In FY22, it went up to almost 75,000 crores. If you remember, in FY22, Tata Steel alone did a 40,000 crore profit. So from 7 to 75 in 2 years, and from 75 to 45 in just 1 year. So FY23 for the year which is just closed, metals profit in Nifty was about 45,000 crores. We're expecting this number to stay flattish over the next 2 years. So therefore, that also means that whatever market cap accretion has to happen will happen from debt deleveraging. A large part of which is also behind between FY22 FY22 because your cash flows were very strong, which most of these companies used to retire their debt. So from a point of view of stock performance, it will be premised on two or three things. One, how does China behave? How does the global growth narrative shapes up? And then company-specific factors like deleveraging, what kind of capex they are doing, where their EBITDA per ton is settling down. In our model portfolio, we are underweight, and our preference within the sector is Coal India.
I understand that from your expectation of Nifty earnings for next year, your earnings are a little muted because of ONGC, Coal India, and BPCL. Uh,
No, actually, that's incorrect. We're expecting a 20% growth next year in Nifty. Perhaps what we are trying to say is that we've seen a 0.6% earnings cut in FY24 estimates because of the cuts that we have seen in ONGC. So
and
that's basically the right.
okay, so basically you've just brought down the growth rate, but it's still going to grow. That's what you're saying.
Actually, we have brought down the growth rate by 0.6%. There has been a downward revision in Nifty EPS for both FY23 and 24. 23 is already done and dusted now. So we ended FY23 at an EPS of about 807 rupees. Our next year's EPS has been revised from 978 to 972, largely owing to the downgrades that we have seen in ONGC. So what is happening is FY23, you've grown earnings at 11%. Next year, you're talking about a 20% growth. This 11% growth is, as I said, entirely led by financials. Without financials, the growth is zero. And therefore, in next year's 20% growth, without financials is also about 20%. So some of the other sectors are coming and contributing to the overall earnings picture at aggregate level.
So give
in
me,
fact, if
so give me a,
itself,
so give me a sense of this 20% growth which is coming in, incremental growth coming in. For how much financials will be contributing and how much ex financials this growth will be coming in from?
So it's a similar growth, Sajeet, because financials are growing at a similar rate at which index is growing. And because financials have a pretty large chunk of the index weight as far as sectoral weights are concerned, and also in terms of profit pool, some of the other sectors which are contributing in FY24, one is auto. Clearly, it is going to continue its journey as we discussed at the beginning of the show. You have consumer also making a comeback at about 17-18% growth. And then some rebound you are seeing in global commodities like oil and gas. In fact, FY23, without commodities, the Nifty growth was 30%, right? It's the commodities which has pulled down the growth, while the financials which has led the growth up. So without financials, no growth. Without commodities, 30% growth in full year Nifty earnings. FY24, reported earnings, 20% growth. Without commodities, about 15 to 16% growth. So things are normalizing a bit in FY24. As far as the aggregates are concerned as we speak. Obviously, these are subject to multiple revisions as we go forward because there are a lot of events which can happen, which can change the direction of the earnings.
What could be the headwinds to this 20% growth in Nifty EPS?
See, couple of headwinds that comes right there in the mind is the commodity price inflation. It can impact some of the B2C oriented sectors, but Nifty is a bit peculiar because eventually Nifty tends to benefit from a rising commodity cost because you have 20% of the profit pool which actually benefits from a rising commodity cost, which is metals and oil and gas. And then there is about 50 to 55% of the profit pool in Nifty, which has no impact of higher or lower commodity prices, which is your financials, IT, utilities. It's only 15-20% of the profit pool which actually gets hurt by rising commodity prices. But what higher commodity prices does is it lowers the equity valuation multiple. The other obvious headwinds could be if you see demand slowdown prolonging in rural India, it can hurt the earnings and the top line growth of consumer as well as auto companies. If there is some asset quality shock, obviously financials will get impacted. And then, of course, some of the other sectors like pharma, where numbers have been very patchy because the margins have not been consistent there. So those are some of the headwinds that one can visualize at this point of time. But Sajeet, the risk always comes from the unknown, right? In FY23, when we began the year, in April 2022, we had an EPS of 870 rupees forecasted for FY23. From 870, we've done 807. So there has been about 7.5% earnings cut during the year because war happened in April and May. Commodity prices flared up. During the year, you've seen 250 basis point of an interest rate hike, which were not forecasted at the beginning of the year. So a lot of changes in the estimates happen as we go forward. They happen from the events which are unforecastable at the beginning of the year.
So two things. We think we are coming at the end of the interest rate cycle. So, do you have you penciled in any interest rate cut for this financial year?
No, not yet.
The
We will
second.
see. I mean, these are all evolving developments. You cannot forecast these things with precision with a in a time bound manner. So we will see how things progress as we move forward, where the inflation trajectory settles down, where the commodity prices settle down. Today morning, you saw a big cut, and suddenly Brent is up from 72 to 75, 76. So a lot of these things are moving parts, which you cannot pencil in right at the beginning of the year.
Finally, we haven't spoken of one sector, which is IT. What's your take there? Uh, and especially on some of the bellwethers like Infosys, TCS, and Wipro?
So, Sajid, IT, we've traditionally liked this space because of the tremendous free cash flow generation that it offers and a very consistent but a low growth. Right now, the sector is a bit headwinded because of what has happened in West as far as demand is concerned. Valuations have corrected. In fact, in CY22, NSE IT index was the worst performing index. It was down 27, 28%. And then it is further down 4-5% in CY23 YTD. So valuations have become far more palatable now as far as large cap is concerned. So our relative preference in IT is towards the tier one large cap names like SCL Tech, Infosys, and TCS. Though we do not expect any near-term catalyst as far as short-term is concerned, but we like the space. It's a amazing sector which has created tremendous wealth over the years. We expect that free cash flow generation and consequent paybacks via dividend and buyout to ensure that beyond a point valuations do not derate.
Do you have a view on how tech globally is doing? Because you've seen Nvidia doing tremendously well, the market cap going crossing a trillion. Then you have other companies like Microsoft, Apple, and Facebook. All, if you look at year to date, how they have grown, it's in 30-40% they have given returns. Compared to IT, where you said that they've fallen by 4 to 5% year to date. Is there a view you have there on how why there's a disconnect in the way the techs perform?
They ideally should not be connected, Sajid, because the business models are totally different.
More
The
product
Indian
led, that's
IT
why.
loves,
Do you think
huh?
more product
Sorry.
led?
Yeah, absolutely. I mean, Indian IT is more a outsourcing-led model, which has done phenomenally well over the last 2-3 decades. Yes, sentiments does rub off whenever Nasdaq does well, or it corrects. You generally tend to associate it with Indian IT. But besides the stock price movements, if you try and link the business models, I don't see any linkage there. So I won't compare them. One segment is done well, therefore the other should do well. That's not a right comparison, honestly.
I'm talking from a point of view of foreign investors, with whether they look at flows going to those kind of companies from traditional IT services companies.
So that will depend upon the performance narrative shaping up. You've seen 4Q FY23 has not been the best of the quarters. The commentary has been very subdued, and this has been the case for last 2 quarters now. I think it will be more a bottoms up company specific factors which will drive the performance of this sector rather than, especially more so in an environment where the demand narrative coming from one of the largest segment of your P&L, which is US, has not been very healthy, right? So if you move forward, say next 1 or 2 quarters and start seeing stabilization of demand, then some of the other factors have been taken care of, which is attrition, which is wage revision pressure, which had impacted the margins in FY22 and large part of FY23. They are now part of the base and have been taken care of. Attrition is already moderated. Wage revision pressure is now absent. Only the demand which needs to come back. And I think that will hold the key as far as the performance of some of this stock is concerned. By the way, in the same sector, you have seen stocks like Persistent, stocks like KPIT and all have done really well. So it all ultimately boils down to how the bottoms up investment thesis is evolving.
Hmm. Finally, what's your Sensex target for the end of the year based on the earnings that you have projected?
We don't have index level targets, unfortunately, Sanjit. But I think from a qualitative point of view, I would not expect much of a re-rating now. The index from a 12 to 15 month should move in line and in congruence with the underlying earnings growth, which checks up going forward.
Gautam, it was a pleasure talking to you today. Thank you very much for joining us on Talking Point.
Thanks, Sanjit. Have a good day.